and Complexity Labs collaboration. We're the co-hosts of Human Current. I'm Angie Cross, and this is Haley Campbell. This will be a 1-hour live discussion with those of us here on the camera. And at the same time, we'll have a live chat discussion happening, which Haley is going to be monitoring. Joss from Complexity Labs is our host for Complexity Live. And today we have two amazing guests with us. We're really excited about the topic that we're exploring on systemic risk. And we have Professor Yaneer Bar-Yam. He is an American physicist, systems scientist, and founding president of the New England Complex Systems Institute. He's also the author of several books, including Making Things Work, Solving Complex Problems in a Complex World. We have Francesco Filia. He's an asset manager, co-founder, and CEO of Fasanara Capital Limited. I hope I said that right. He's appeared on CNBC several times and recently released an ebook about financial complexity and nonlinear dynamics in partnership with Complexity Lab, which, by the way, was fantastic. So welcome, both of you, our guests. Before we dive into there, I'd just like to first pass it over to Haley to give a little brief intro of Human Current, and then we'll pass it over to Complexity Labs and then over to our guests.
So we are the co-hosts for the Human Current podcast. We have casual conversations about complex system science and systems thinking and work life and all the things that we do. We just recently released an episode with Dr. Daniel Stickler, which was recorded live at the 9th International Conference on Complex Systems. We talk with him about the human system being a system and how medicine is really failing us by addressing our system as a complicated machine. So that was our most recent episode, and then we're also going to air new ones from the conference, as the weeks go on. So stay tuned.
Thanks, Haley. Joss, over to you. Can you give a little background to Complexity Labs?
Sure. Thanks a lot, Haley. Complexity Labs, we're an online platform for complex systems, produce courses and research and so on. I run the website, and I've done a lot in risk. I mean, it pops up kind of everywhere. In social systems, social collapse, ecosystems, infrastructure, cybersecurity, pandemics, finance, the big one. It's kind of a topic that cuts across so many different issues and is so relevant for so many different things. Just this year, you think about climate change and how that's really started kicking in, right? And that's systemic risk, isn't it? I'm looking forward, and thanks a lot, Yaneer. Thanks, Francesco, for joining us.
Thank you, Joss. So, Yaneer, can I pass it over to you real quick? Can you share a little about Nexi, New England Complex Systems Institute, and a little bit about yourself?
So, Nexi is a nonprofit academic research institute in Cambridge, Massachusetts, and we do research both on the fundamentals of complex system science and on applications that range widely, but include a lot of work on global challenges, the financial crises, the pandemics, social disruption, and so on.
Great, thank you, Yaneer. Thanks for being on Complexity Live today. Francesco, I'll pass it over to you.
Yes, thank you for inviting me to this event. My name is Francesco. I'm the founder of Fasanara Capital. Fasanara Capital is a boutique asset management firm based in London. Fasanara Capital started in 2011. Prior to that, I was in Merrill Lynch, and prior to that, I was in JP Morgan in 97, 98, 99. Our asset management company looks at public markets, the liquid securities, and also illiquid securities. We have a broad range of mandates from our investors. And in the past few years, we have been studying the issue of systemic risk in capital markets, and also approaching it from the viewpoint of using also some of the techniques that we learned in complexity theory, which we thought they were totally applicable to markets, and they could help a lot in shedding a light on what is going on right now in financial markets.
That's great. Thank you very much, Francesco. And we have our live chat as well. I invite those that are listening in and want to chime in on the live chat. And every so often, I'll ask Haley to bring in that conversation. So I'd love to kick us off with just even defining what systemic risk is as we have this conversation over the next hour. I'd like to unpack that a little bit. So let's define systemic risk and how does it relate to complex systems or complexity science? And Francesco, I'll start with you.
Sure. I mean, when it comes to financial markets, systemic risk is differentiated from idiosyncratic risk. So I'll start defining it from what it is not, which is idiosyncratic risk. Idiosyncratic risk in financial markets is defined as that risk which has got to do with a specific situation in a specific country for a specific company, for example. So it's something that is not related to a broad-based financial instability, but it's, for example, the default of Enron, the commodity trader in the US more than 10 years ago, or it is the default of a bank like Lehman Brothers. Now, the idiosyncratic risk can result into systemic risk, can kick off a chain of events that eventually lead to trouble for the overall system as a whole, but not necessarily so. So this is the idiosyncratic risk. The systemic risk in financial markets is defined as that sort of tension for the system as a whole, for the market as a whole. So, for example, for the whole of the equity markets as defined by the index Standard & Poor or the index Nasdaq, or for the global bond markets. And it's something that has got to do with the system as a whole. So for like big blocks of securities or for countries, it's typically associated with the moment in history in which we experience depression-like economic situations, vast fallout in public indices, so for the markets as a whole, for good and bad companies alike, and where we experience also sequential failures for corporations on a large scale. So it's typically defined also by the magnitude as a share of wallet of the total. Big examples of systemic risk are the ones associated with the global depression of 1929, the global financial crisis in 2007, to a lesser extent also the dot-com bubble of year 2000, and you have a few more occasions in which systemic risk was striking. Typically, historically, it has been associated with the with banks, with the financial institutions that were going belly up, and they were leading to a sort of chain reaction that was eventually affecting also the real economy and ultimately leading into a recession and a depression at some in certain circumstances. But it does not necessarily have got to do with financial institutions. And then in the next in the next few minutes, we can also discuss why, for example, in our opinion, these days it's got more to do with the asset management industry and less to do with banks, differently than the past.
Thank you for that. And I'm not sure, I think I got most of what you were saying, Francesco. It sounds like there's something going on audioly, so I just wanted to let you be aware of that. I'm not sure what that is. I just wanted to bring that to your attention. Thank you so much for adding that context to systemic risk as you work with through your industry. And Yaneer, I'm curious, do you have anything to add? How would you define systemic risk, and how does that relate to complex systems?
Sure. Let me start with a more basic presentation. If you have many components of a system, and there is a sense in which you have a bad event that can happen to a component, then there's a question as to whether an individual component with such an event, whether it is independent of other events that happen in the system. And if the events are coupled or linked so that they can either events propagate or they happen together, then when the events that happen in unison or in a combined way are sufficient to threaten the entire system, then that would be a systemic risk. And things can happen in various ways. So system change happens when there's gradual change across the system, across many of the components. And second, there you can have extreme events that affect many different components of the system through one event. And then you can have transitions in behaviors that affect the entire system. So when we think about systemic risk, we think about events that are adverse events, but more generally understanding sort of the things that can happen to a system as a whole. There are these other possible things, which are progressive change, there is events, and there are transitions. And when we have a system that is vulnerable to having these kinds of large-scale effects, we talk about the vulnerability of the system, and that's really what we mean by systemic risk. So systemic risk is linked to a concept of vulnerability, and vulnerability means that when events happen, they combine different parts of the system into a large-scale behavior. Now, not all systems will have a risk of having combined events. And in particular, if our world was more separated, where every locality had its own economic activity, political activity, and so on, then you wouldn't have these large-scale events across the entire system. And really what complex systems science does is it studies dependencies. And so the study of dependencies and the study of systemic risk are inherently linked to each other.
I want to go into some other areas that we're seeing systemic risk, but I want to follow up with that question, Yaneer, as you talk about complex science and how that relates to systemic risk. And I think of, is systemic risk only relevant with complex nonlinear systems, or does that matter? And why or why not?
So, I mean, when we think about systemic risk, we're thinking about systems that are large interdependent systems of many components. So it is, in some sense, by definition, the domain of complex systems. They are nonlinear in the sense that when things happen together, the collective of the system means that you don't have a linear effect. By pushing a little bit, you get a small effect. If you push a little bit and everything moves together, then you can have a very large effect.
Great, thank you for that. And I actually want to ask Francesco the same question as well. And I know you probably see this a lot in the financial work that you do. Can you see systemic risk only relevant with complex nonlinear systems? How do you see that showing up in your work? Oh, we got you muted here. Got you muted. There you go.
You hear me better now with the mic. So complexity theory can help a lot in understanding nonlinearities in capital markets. Nonlinearities are very evident in markets at multiple points in time, especially during a big market crisis. So if we look at the crisis of 2008, the latest one we've seen on a larger scale, you could clearly see points of acceleration of debacle in asset pricing and chain effects and all sorts of amplifying feedback loops that were affecting the market at that point. And one of the teachings from complexity theory that is easily forgotten in capital markets, where in capital markets basically the complexity theory really very rarely shows up. There is very little that has been done to apply it on financial markets. The reason why we got interested into it is because we thought that is a big mistake, and we thought that a lot more could be done. There have been works on agent-based modeling, on some of the techniques that are utilized, but a lot more can be done. And one of the easiest example for when complexity can be applied on financial markets has got to do with linearity. So typically, and this is true for the human brain, I guess, in general, but especially in financial markets, there is a tendency to look for a linear cause and effect relationship. So this happened in the financial markets. Lehman defaulted. and this is the cause. So prime mortgages, for example, in that specific case, which is typically what the financial markets are all about. Trying to understand that one trigger that created the problem. Whereas very often, what can be seen is that the big crises have occurred after a long period in which they have been incubating, and during that long period, you had all sorts of recognizable features which complexity science talks about and isolates them, and which they help you to see the process of systemic fragility unfolding and building up and compounding over time in a surely and safely. So, for example, leading into the Lehman crisis, and the same we think is happening right now with financial markets, you could see at play, positive feedback loops, which were reinforcing, which were like self-amplifying, and they were provoking a divergence for equilibrium for capital markets. So, where in the capital markets jargon, where valuations were disconnected from reality and from fundamentals, so where the price of equities, for example, was trading at multiples never seen before, meaning that all was all of a sudden very expensive. And the question was, why did we get into that territory? And the answer was very often perverse incentives and the positive feedback loop, which were occurring between, for example, public activities from central banks and the private investment community. So positive feedback loops is one big element which is never discussed in financial markets. It should. Nonlinearity, so do not look for one single cause and effect relationship, but rather look at the system as a whole and recognize that, for example, there is something which is totally rational for investors to do on an individual basis. But then if all investors do the same at the same time, it becomes a systemic risk on an aggregate basis. And so that is, again, something which happened during the Lehman time, something which is happening again today, and which could be helped in terms of framing it and understanding it using complexity science. And another thing that I found very useful in looking at capital markets through the lenses of complexity theory is the analysis of early warning signals. So like early warning signals in the studies of, for example, Martin Scheffer and others are those, much better than I do, are those general properties that are common in ecosystems and that can be seen in fisheries, in lakes, can be seen during times of glaciation, can be seen all across. And funnily enough, they are global properties which they relate to each other. They are recognizable at certain point in time when you approach a critical transition. And those elements can also be applied to financial markets. And for example, and then if we have time, we can go through that list. For example, today in capital markets, a few of them are easily recognizable. And therefore, the theory could be that if you have reasons to believe that the system has got inherently fragile, and there is financial instability, and there is financial fragility, then you should probably be on the lookout for those early warning signals in order to determine as best as you can a probability of transition, which means a probability of being approaching at some point a big market crash in capital markets jargon. You can never be sure about when it would happen. You can never be sure about the timing on that, but it can help you, in analyze markets, in putting a frame all around, and be better equipped to interpret events as they unfold.
Thank you for chiming in on that. And Yaneer, Nexi has done some research on this. I wonder if you can talk a little bit about the research that Nexi has also released on economics.
Sure. So I think the language that we like to use to describe the kind of collective event that we're talking about here is a panic. And we've published a couple of papers on understanding how panic can be understood and observed and used as an early warning signal on financial markets. There's a paper that people can look up called, let's see, it's called Predicting Economic Market Crises Using Measures of Collective Panic, I guess there's a second version of this, which is called anticipating economic market crises using measures of collective panic. So the idea is that when we have everyone doing the same thing, as in selling all at once, that's a symptom. That's a
Oh, it looks like we have lost Yaneer.
Oh, no.
And I'm hoping you will chime back in. And I'm not sure who Alice is. So Yaneer, hopefully you're able to still see us on the live and can jump back in. In the meantime, I'm going to pass it over to Francesco. If you'd like to add in, Yaneer was just talking about panic and the research that they've released on that. And I know much of your work has also talked about early warning signals and how to pay attention to those. So can you chime in around how do you see early signals showing up? And then I'll bring it back to you. There's Yaneer. He's back.
Sorry.
That's
Oh,
all right.
no.
Francesco, I'm going to come back to you with that same question. I'll let Yaneer finish his thought here. I'm going to ask you the same thing.
Okay, apologies. In the process of going around.
Glad you came back.
I lost. But so we were saying that if you think about panic, what happens in normal times is that everybody is kind of paying attention to the value of their individual stock, and then they buy and sell accordingly. But when people are worried about the market going down, what they do is if they see it go down, then everyone else says, well, if you're going to get out, I better get out. And so there's a panicky behavior. And you can see that, and that's the kind of feedback that Francesco was talking about. You can see that in the dynamics of the behavior of a market, and you can use it not only as a signature of the panic itself, but you can see it ahead of time. So you can see panicky behavior before a panic happens. And we use this to predict the last 10 one-day panics on the market with no false negatives and no false positives in the prediction of those panics since, from 1980, it was 85, I think, over 30 years. So this is something that can be done and used to understand the dynamics of markets, as Francesco said. Now, in addition to studying the dynamics itself of the panic, it turns out that there are also things that change the vulnerability of markets in terms of these collective behaviors. And that can be influenced by changes in technology or by changes in regulation. And we often think about, and I don't know if you want to go into this in detail now, but we often think about the idea that free markets are counter to regulation. But that's only true if regulation is about price setting. There are also regulations that are important to create the structure of markets. Every market has a set of rules about how you go about doing things that is an enabling thing for markets. And it turns out that in order to enable markets to function well, you have to inhibit at some level the tendency to collectivity, right? Because monopolization undermines free markets, right? If you have a monopoly, there really isn't a market. And there's a dynamic version of monopolization, which is panic. It's clear that panic undermines markets. Examples of this include things like what is the crash that happened? I've forgotten what it's called. The one day, sort of within half an hour, the market lost a huge percentage. Some stocks lost 98%. What was it called? What?
Flash crash.
The flash crash, exactly. So the flash crash, the regulators undid a lot of market activity because it was clearly not economic trades, showing that kind of behavior, of a panicky behavior that was also facilitated by technology, is something that undermines the very essence of what free markets are. And so when regulatory changes happen, there is a change in the underlying dynamics of markets. And we've devoted a fair amount of attention to understanding how various changes in regulation over the years have affected the stability and vulnerability, i.e. the systemic risk associated with markets. And I can talk about it a little bit more, but maybe I'll let someone else talk first.
Yeah, thank you for adding that, Yaneer, and I'm so glad you're able to join back in on the conversation. Francesco, I was just about to ask you the similar question to Yaneer, and I wonder if you can chime in on this. A lot of your work and what you've talked about on CNBC and even your ebook preview talks about the early warning signs, and it sounds, Yaneer, like there's almost like a feedback loop that you're talking about, and so I'm wondering, Francesco, like what are those early warning signs that you often see or that we could be looking for, and what do we do with those early warning signs, and how's that all related to the feedback loop that's being created? I think you're muted.
I always forget to
there we go.
activate the mic. So basically, like obviously, like in finance, you like to look for mathematical equations. Now, complexity theory, the way I understand it, is no closed-end formula. Is obviously like it gives you the tools to interpret things, but there is a high degree of like qualitative intervention that you need to apply to it, and interpretation bias, obviously. But the way we have tried to translate and bridge the gap between the theory and the practice when it comes down to markets, based on our experience on markets, bottom up, has been to split it in three categories. So what we call the tipping point analysis, the early warning signals analysis, and then the butterfly analysis or triggers analysis. The tipping point analysis is to understand the system as a whole. Now, this is done very, again, qualitatively, right? It's very difficult to put the numbers on it and be really too precise about it. But basically what we want to mean by tipping point analysis is to look at capital markets, look at the direction of expansion. So we clearly look at systemic risk from the viewpoint of systemic risk. Systemic risk for markets means bubbles formations. When do the equity market and the bond market are in a bubble? And when does the bubble stop to inflate itself further? The typical capital market guy or the typical regulator, the typical central banker will tell you there is no way to know a bubble except in retrospect. And so there is no way to anticipate a bubble, which we kind of disagree upon. I mean, there are some things that you can do about it. Tipping point analysis may help you out. So you look at the bubble and the capital market system as a whole. You look at the possible direction of expansion that they can feed and feed the bubble further. And for the capital markets, it boils down to four things, especially these days. The valuations, so how expensive a stock can be, because we can all argue that the washing machine can get more and more expensive, but at some point, when it costs $30,000, maybe it's too much for a washing machine, and you will stop buying it. So valuation has a merit, and it should be the starting point of all analysis. Then there is the indebtedness, because most of what you buy, especially ever since 1971, after the Bretton Woods, is bought on credit. So credit has a big function in terms of boosting the asset pricing. So how much can debt expand further? On the other end, cash. How much cash is on the sidelines? Obviously, if people have borrowed money, they've got cash. If they've spent the cash already, there will be less cash to spend afterwards. If they have more cash to spend, then the bubble can keep going and going and going before it stops growing further. And then finally, external intervention. And this is like, these days it could be quantitative easing. And the concept is taken from entropy, where basically in an isolated system, entropy keeps rising or tends not to decrease, except if the system is not isolated, which for financial market could be the external agents of manipulations of stock prices on the side of quantitative easing and negative interest rate policies and zero interest rate policies. But if you look at the four dimensions together, as opposed to each of one in an isolated manner, you may want to come to the conclusion that you may not know each one of those how much they can overextend itself, but you can see that there is a synchronicity capacity constraints across the board. So on the 4 of them, for different reasons. So now it becomes a systemic issue, because if the system cannot expand in none of those typical dimension of expansion that it has experienced historically, then it may stop expanding. And at that point, it loses, it runs out of steam. And at that point, it can go into a transition. At that point, the bubble can stop inflating, and you can have the reverse happening, and overcompensation to the downside, and the market crash, and all of that associated to that. Roland Coopers from the Systemic Institute talks about it nicely when he says that when the system is tight in all directions, it loses flexibility, it loses the buffers, it increases system efficiency, but at the cost of resiliency. And when it's tight in all directions, it starts to behave weirdly. It starts to do weird things, and that's when things happen. And so this is the tipping point analysis. And I hope I'm not already too long. Otherwise, I will speak a little bit about the next segment.
Yeah, continue on with the next segment. And then after that, I'd like to throw it back to Yaneer around different research that's come out from Nexi and how it relates to the economy and also food and other systemic risks. So yeah, carry on there, Francesco.
Okay, so basically, like the next one would be, so the tipping point analysis tells you, like you may not agree with the conclusion, but let's say that it may tell you that the system is tight in all directions. So the system has hit capacity constraints in synchronicity. So that gives you kind of a warning signal in itself that something may be happening. So if you have reasons to believe that the system has become inherently fragile and vulnerable, and that the system has become exposed to vulnerability, then the next step is to look for early warning signals, which they become confirming signals. And that those are those common properties which are always true across different disciplines. And that's when it becomes really interesting and also, in my opinion, fascinating, this work. Because then you can borrow from something which is true in physics and borrow with something which has been true in schizophrenia, for example, on the human brain, and try to see if there is some commonality, which should tip you off if something is indeed confirmed and something may be therefore happening. Early warning signals, there is a long list in our research. We look at it in the paper we published with Joss. There is like a list of the early warning signals that we see relevant for the current market. One of them, again from Professor Martin Scheffer, is the conditional slowing down, because it basically tells you that the rate of recovery slows down when you are closer to the cliff of the basin of attraction, so when you're closer to transition. And that can be seen in markets as well, very easily. It is after a perturbation, you have the market correcting itself quickly as opposed to slowly. If the rate at which the market recovers slows down, that may entail that the cliff may be ahead of you. In market parlance, you look at the quick recovery after Trump won the election. You look at the quick recovery after Brexit happened. You look at the quick recovery after the market sell-off in January 2016 and February 2016 because of the oil price and the Chinese renminbi devaluation. And you see that the recovery that took place this year, for example, after February, was much slower. So you see that for the first time, you saw something different. And that may be put in the category of critical slowing down. And then there are other characteristics, but I will stop here.
I think it's really interesting too, the perspectives that you bring in. I keep hearing these patterns forming and how patterns emerge and that we can learn from other systems. You know, systemic risk is in so many areas. I could think of a long list of areas that systemic risk exists, and that it doesn't just exist on its own. I think of economics and that food is related to that, and how the environment is related to that, and other ecosystems. And so, my wheels are turning over here. Without me rambling on too much about my perspective on systemic risk, Nexi has done a ton of research as it pertains to economics and ecosystems, et cetera. So I'd love to hear what you'd like to add on to that.
Sure. I mean, I think Francesco spoke very well about, many of the different aspects of this. I think that, we have been looking at this in certain specific circumstances. Again, going back to the financial crisis, there was early indication of the increasing vulnerability of the system in the early knots as a result, and this resulted in the network connectivity in the behavior of the system increasing. And we published a paper on the interdependence in the market, which shows how companies started out being very independent and then ended up being very dependent in their dynamics, leading up years before the financial crisis happened, signaling that the system was coming to a vulnerability or to a condition of likely collapse or transition. That work was linked to the real change in the separation in the banking sector between, right, this is the separation between commercial and banking and mortgage and other kinds of banking, investment banking and mortgage banking. The another example of this work was in studying the European bond crisis, where we were actually able to project and identify the time of default of countries in Europe. The expected default time could be predicted based upon an underlying theory and dynamics of the transition from a condition of stability to a condition of going across the instability horizon of countries' ability to pay for their debt. And more, I think Francesco separated the identification of kind of the vulnerability from the signature, but in many cases they can be combined together into the same analysis. And an example of that is work that we did on understanding the dynamics of food prices, where the increasing value of food prices in 2007 led to a peak, and the peak then and a decline, and the analysis could predict not only the increase but also the time of the turnover and decrease in prices of food. And we've done similar analysis of oil prices. So understanding the underlying dynamics, if you will, the nonlinear dynamics of the behavior of systems can really give rise to an understanding of both when you're approaching a transition and when the transition will happen. And of course, there are times when signatures of fluctuations can be an indication of when the transition will take place. That's very typical of any kind of transition. And a very different example where we've done that is in the context of pandemics. We studied the transition that the world is undergoing from a stability when diseases are primarily local to when they become global as a result of increasing global transportation. And in that context, that transition obviously gives rise to a vulnerability that is kind of scary, right? And in that context, we predicted that there would be a large Ebola epidemic. And we made that prediction years before the outbreak in West Africa confirmed that the system had become much more vulnerable to these kinds of large outbreaks. That's a different example, not a financial example, of systemic instability. In the next segment, I think it would be also good to talk about how these different aspects of global change are connected to each other. And maybe I'll talk about that a little bit. But I think that for this purpose, in this piece of the discussion, I think there is a real opportunity to understand the dynamics of vulnerability. And we are, if one is interested as an investor to understand the dynamics of vulnerability for the purposes of investment. There is advantage there, clearly. But there's also an advantage from the point of view of policy to make sure that those vulnerabilities don't lead to real systemic crises that can affect, global populations. And if I can give an example first on the financial side about this, we've done an analysis of the sort of overall economic activity and how that links to the regulatory effort of the regulatory effort associated with Federal Reserve and policies. And I think we should get there in the discussion, but the insights that it gives us about how we are today extremely vulnerable to recession and systemic economic problems is important to understand.
Yaneer, I'm wondering if you can go back to what you were saying, that you touched on Ebola, and I know that there's also been some research that's come out with that, and some pretty surprising research. I'm not sure it's being talked about in other areas. I wonder if you could talk a little bit about what you're learning with the Ebola, and if you can go from there.
Sure. I mean, the statement that what we studied is not just about Ebola, but about what happens as you add more and more connectivity to a system that has a particular dynamic, a dynamic where there is one species, in this case, a pathogen, and it is, if you like, consuming another species, which is the host, right? Diseases that kill us are basically, in some sense, eating us. They're like a predator-prey system. And when you think about that system, it turns out that the pathogen is limited in the degree to which it can be lethal. Because if it kills off all of the hosts, then there are no hosts and it will die out. And if you have a system that has local transportation but doesn't have global transportation, then the pathogen will kill the host locally and then it will die out locally, but it won't kill everybody or everybody in the system. But as you add long-range transportation, the pathogen becomes more and more aggressive. In other words, it evolves in its properties to become more and more aggressive in its behavior because evolutionarily, there's nothing stopping it from becoming more deadly and more aggressive. So our study showed that there is a phase transition, a sharp transition from a condition where there's kind of local outbreaks and local extinctions to a condition where there's global extinction at a particular amount of global connectivity. And if there's such a transition and we're adding more flights, today we have another flight from, A to B, city A to city B, and there's more economic development that's causing more rapid transportation in previously undeveloped parts of the world, including Africa, the risk of a disease, which is a horrendous disease like Ebola or other diseases spreading extensively across the world, becomes higher and higher until you get to the point where you go through that transition. So we wrote a paper about this in 2006. We published it in 2006. And I've been trying, and as you said, there hasn't been enough discussion of this, to communicate about the fundamental risk that is a changing risk. We cannot understand this risk just by thinking about past events, because the past events that we've experienced are not including this change of the underlying condition. So as a fundamental statement, prior experience is not a sufficient predictor of future events. And the future events may be very severe and may get us maybe indeed transitioning to this regime of extinction. And in order to address that, we really have to fundamentally change how we think about and prepare for outbreaks and disease propagation. Basically, our world is becoming systemically vulnerable to pathogen outbreaks. And if we don't pay attention to it, we're going to be in very severe trouble.
Yeah, I'm glad you brought that into the conversation. It's kind of shocking that we don't hear more about it. I mean, even the swine flu happening in China, and we don't hear conversation about it. And I think, patterns are definitely important to look at. But as we're in such a nonlinear system and in a complex system with a growing network and so many agents, it's hard to just look at those old patterns. And I mean, yeah, I agree. There
are actually 4 outbreaks going on right now that are very severe. One is an Ebola outbreak in the eastern DRC, which has already killed more than 100 people. It's about 100 people it's killed. There is malaria that is very widespread. I think it's is it malaria? I think it's malaria. I have to remember. It's in Zimbabwe and someone look it up quickly. Zimbabwe and Nigeria, and then there is there was these cases of monkeypox that ended up in England, coming from Nigeria, and then there is a MERS outbreak that is being transferred from Kuwait to South Korea, and all of those are happening just now.
Haley's getting excited over here, chatting in my ear with asking about financial systems, and just to tie that back over to financial systems. And I know that all plays a role because we're so interconnected. And I'm aware of the time. We have less than 15 minutes left. I know that there's a live discussion with some great insight there, and I want to hear back from Francesco. And I know, Joss, you've got something to add, and we're of course over here going, but
and 2 hours long.
Yeah, we wish it was a lot longer. So with that, I'm going to shift a little bit to Haley's point around the financial piece. I think, Yaneer, you could definitely add in on that. And just to bring Francesco back in here, if you could add on the financial piece too.
Yeah, how are financial systems linked to like these outbreaks and other, systemic risk that's happening? Even we're talking about global warming. We have a hurricane hitting the Carolinas right as we speak.
Yeah, and a tropical storm over Hawaii. And yeah, so...
Let me I'll do briefly, I'll make one of these connections, and we'll have to talk about others some other time. But one of the links that we've made is from the financial crisis leading to shift of monies from the mortgage and stock markets into the commodity markets. And the commodity market shift led to an explosion of food prices. And the food price explosion is what triggered high food prices, triggered the riots and revolutions of the Arab Spring, which led to social disruption and the continued disruption in Syria and Libya and other places. And also, of course, the incubation of ISIS and the refugee crisis in Europe. And so we see this incredible cascade of global events that went from, the US mortgage market into the food market, into social unrest, political instability, into disruption and terrorism, and into refugee crises. And we're able to trace these dominoes through the system. But the fact that we understand it means that we really now have to go back and think carefully about the policy decisions that we're making, because it turns out that the financial crisis and the food price increases were triggered by deregulation of markets in the United States that led to this vulnerability that then led to the dynamic behaviors that we talk about today as the financial crisis.
Thank you, Yaneer. And I do want to come back to Francesco too. Do you have anything that to add to that as well?
Yeah, sure. I mean, it's very interesting, very fascinating. idea of connectivity, so the transportation for Ebola, has also a translation in financial markets that I can see these days. Yeah, just to give another example of how that might translate into financial markets, it is really the passive asset management industry in the form of ETFs and passive index funds. Those are vehicles which they may be, like they may be like compared with what Yaneer was talking about when he was talking about transportations and weaker connectivity nowadays than in the past. And basically, they are vehicles that they have disseminated across certain pockets of exposure to financial investors across the globe. Across those vehicles can be seen a lot of crowding because like basically what happens today, for example, is that the big tech companies are filling the coffers of a variety of different ETFs around the globe. So no matter whether the ETF is low volatility inclined, or it's a technology ETF, or it is a global equities ETF, or it is a US stocks ETF, or it is a new economy ETF, or all the sorts, you will always find a presence of a handful of stocks, including the big market darlings, the technological stocks. And that increases, I think, connectivity, it increases systemic risk, it increases the potential for chain effects. If something happens to one of those large stocks, which is present everywhere across the ETF industry. We had an example this year in February. There was one ETF which was like playing dangerously with volatility, with the VIX. It was a short vol ETP for the for those that are familiar with it, and it blew up in the span of one day. That was an isolated case. It didn't knock on into a broader market implication, at least in a durable manner. But it's just, we think, the tip of the iceberg, and through ETFs we may see quick transmissions of diseases across the financial system, which may lead into like some more severe rupture and transition.
Oh, thank you. I'm so glad you're able to add into that too. I didn't know a lot of that. Thank you for that. I'm aware of the time. I want to check in with you, Joss, and I know you've got something you want to add into here. And then I also want to hear from the live discussion, what's going on. There's some great dialogue. And I also want to allow some time for some wrap up and to hear of some upcoming projects. And so with that in mind, Joss, I pass it over to you.
Yeah, just to continue on with what Yaneer and Francesco were talking about there. I mean, they were both talking about connectivity, right, in financial markets with pandemics, and that's really just happened across every kind of aspect of economy and society and technology. That increased connectivity over the past 30 years, and that's really been like, in a way, a kind of phase transition or a regime shift, that massive amount of connectivity. I mean, if you look at almost any kind of area and you dig into it, you'll see like there's just more nodes and there's more connectivity between those nodes. Also, it's kind of faster. Whether you're talking about like the global supply chain or finance, or you're talking about, I don't know, migration or media or the internet or so forth, every single one of those. And because of that, and the same things that you were talking about there in pandemics, in finance, of those, that as you go from a relatively independent kind of world where the borders kind of apply to activity, you network them into a whole system, and then things can spread across that whole system and you get systemic risk. You can have kind of system-wide processes that disrupt the whole system, like the financial crisis is very, very good. But I guess, I mean, just get back a little bit to the theory. I know we haven't got much time, but it's like systemic risk is risk applying to the whole system. So as Francesco was saying, you can have risk that applies to a part. He called it idiosyncratic risk. Which is just like one part. Like you think about global security, you might have North Korea, and that might be a risk, right? But that's not systemic risk. That's just one part. And then systemic risk is like, it's actually applying to the whole structure of the system. So cybersecurity is a good example of systemic risk. because it's actually security pivots around the fact devices now, we all have connectivity, and all of these devices, we as individuals, we don't secure those devices very well, and they can be harnessed by attackers to go and attack some system, right? And that's actually like a negative externality. All of our behaviors, not securing our passwords and so forth very well, is leading to an overall kind of critical state where those can be used to attack other things. So it's, I think, two important things that I didn't hear talk very much about. One is externalities. I think a lot of this is about externalities. When an agent in the system, when agents in the system start doing things that leads to negative externalities, that accumulates in the whole system and it erodes the structure of the system, and that leads to a critical state where small changes can cause large systemic effects. Like the financial crisis, you know, all those people trading those toxic assets, a lot of those companies knew that those were overvalued, but they still put them out there, right? And eventually those toxic assets built up, and that was a negative externality. They built up in the system till it reached a critical point. Then a small change, you know, the subprime mortgage in America, that's really small, you know, compared to the global economy of $100 trillion or whatever. That shouldn't really affect it. But because the system was in a critical state with all those externalities, it actually managed to, you know, really affect the global economy. Half of the value of the global GDP was wiped out because of that, but it shouldn't have caused that effect, that kind of scale of effect at all. So I think there's actually two things that we've kind of talked about. One is Francesco talks about a lot is non-positionalities, and the other thing we're talking about is connectivity. Yaneer was talking about it a lot, and that's kind of coming from the perspective of network theory and looking at how connected things, but also how connected things are, but also talking about kind of critical hubs, like how centralized that network is really important. A distributed network is a very kind of resilient system compared to one where you've got, you know, just a lot of countries now, they just have like 4 major banks or 5 major banks, you know, compared to you could have a system that had 100 banks, you know, and that'd be much more resilient.
Right, good point. Thank you for chiming in there, and that was a great way to wrap up this conversation. I do want to allow, we've got just a few minutes left. I just want to hop over and hear about what's happening over in the live chat, and then to do a quick touch base with everyone around upcoming events and announcements. So Haley, what are you hearing over there in the live chat?
Yeah, there's been some great discussion. It's great to see people are conversating between each other and also asking questions. I know we don't have a whole lot of time to really specifically address a question, but a lot of them are kind of around this of how do we predict risk, or how do we look for risk in systems, and do we need big data sets to really do that? Like, do I need to be a scientist to be identifying these things? And obviously you can, you know, always stay tuned with upcoming research out of the complexity science at New England Complex Systems Institute, so we could get our information that way. But how do we really identify these risks, you know, individually? And I thought about Nassim Taleb's work. Mm-hmm. His book, Skin in the Game, you know, is a brilliant way to be introduced to these concepts that you can start to identify it without really being a scientist. You can see where risk is showing up. His book has been eye-opening for me, so I highly recommend that. And Yaneer is going to be conducting a course with Nassim Taleb at the New England Complex Systems Institute this fall. Do you want to talk a little bit about that, Yaneer?
Yeah, that's a great way for us to wrap up. Any other announcements too, Yaneer? We got you on mute, Yaneer. Well, you take yourself off
Yes.
the mute. Oh, there you are. Okay. And just as you jump in on that, I also want to just give a quick thank you to those that have joined us on the live chat. So over to you, Yaneer, any announcements and to talk about the winter program?
Sure. Well, we have a program coming up at the end of October. It is a 1 week combined of 2 different half-week programs. The first is on artificial intelligence and analytics and understanding how we use big data analytics in order to understand various challenges. And the second is on strategic analytics. How do we create a larger scale picture that enables us to think about the kinds of systemic problems that we've been talking about today.
Thank you, Yaneer. We'll be sure to include a link to in the live chat that's going on. Once that's posted, we'll send out some links. And Francesco, you've got some really interesting work happening over there. Any announcements or anything you'd like to share in their wrapping up?
We put our research material on our portal, which is www.fasanara.com, which is where we put all of our pieces related to the market. And we will continue to write it. Our next research piece has got to do with the Ricci curvature, for example, as a way to look at the markets and identify points identify fault lines and points of saturation and points of like crowding, which is similar to entropy. And I think there is a lot that can be done on the field. I love the opportunity to discuss this also from a more scientific point of view, because there is a lot that could be applied to financial markets that is not at present. The financial markets are, I believe, they have a long way to go before they can really frame a systemic risk properly. Nowadays, for example, the whole market is inclined to look at volatility as a risk indicator. So all the value at risk models are all about step out of the market when volatility is high, whereas it is actually totally the opposite if you look at it from complexity theory, where high volatility may be looked at as a negative feedback loop. It's the one that takes you away from far from equilibrium dynamics and keeps you safe, in a more stable territory. And there are studies, is a heavily researched field where when it's really actually after long periods of low vol that you end up in trouble because there is complacency and people overextend themselves. So a lot can be done, and thank you for inviting me to this chat.
Thank you for joining us. And just also, you have such a great, the ebook that you worked in partnership with Complexity Labs was great. I think we could probably watch that a bunch of times and still get stuff out of that. We'll make sure that we add some links to that once the discussion is posted. We have Complexity Live happening every month. The next one will be October 12th at 6 p.m. GMT, which is 1 p.m. CST and the topic, I believe, Joss, I'm going to pass it over to you for a second to wrap things up, but I believe the topic will be system design. So we're looking forward to that. I know this conversation was so rich and we could have gone on for hours. I still have a long list of questions, so I could be easily asking you all post this discussion, but I definitely want to thank you for taking the hour to be with us and share your expertise. And on that note, Joss, I'd like to pass it over to you to wrap up.
Sure. Thanks a lot. Yeah, definitely. That was my favorite discussion so far, actually. I think that definitely could have done 2 hours of that. What did I want to say? Yeah, our next topic, systems design, next in October the 12th. And what we got coming up, Complexity Labs, we're doing our course on systems innovation at the moment. So publishing videos on that over the next few weeks. I just want to say that I think Yaneer and Francesco, they're both doing great work, especially Yaneer. I'm a big fan of your work. The research you were talking about there, linking food to finance to riots in the Middle East. And also, you can think about climate change too there, because that was a big factor in Syria, wasn't it? Why the people moved into the cities and so forth. But I think you're both doing great work. It's good. Francesco is bringing complexity to finance, and what Francesco is doing is great. So I want to promote that. So thanks a lot for joining us, guys, and let's leave it there, and we'll talk again next month.
Thank you.
Thank you.